Hi, this is Kathleen Uckert. I'm a senior analyst at Valueline. I'm here with Alan House, who is another senior analyst. We here at Valueline hope you and your family are doing well during these tumultuous times. Many of you may be familiar with our flagship product, the Valueline Investment Survey. But we also have other more premium services, such as the Valueline Select, the Valueline ETF service, and the subject of today's presentation, Valueline Dividend Income and Growth, which is our premier service. Before I jump into the heart of the presentation, for those just joining us for the first time, I want to provide a brief overview of who we are at Valueline. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Valueline Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ stock market, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Valueline's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Valueline has no investment banking business with any company, including all the equities under our coverage. Valueline does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUELINE. Reports in the Valueline Investment Survey provide a concise, one-page overview of a company's operating results, financial position, and forward-looking projections. Valueline Dividend Income and Growth, on the other hand, provides a more detailed, more in-depth analysis of one particular company and an alternative that we believe is worthy of highlighting. We tell you what stock to buy and when to buy it. We also tell you when it's best to hold the stock and simply maintain your position, neither buying nor selling. Most importantly, and what sets Valueline Dividend Income and Growth apart from competing services from other providers, we tell you when to sell, whether that's to maximize your returns or to exit a position that we believe no longer has superior prospects. A few examples of Valueline Dividend Income and Growth buy recommendations include American Electric Power, ticker symbol AEP, which is a major investor-owned electric utility in the United States, delivering electricity to more than 5 million customers in 11 states. The company was added to the Dividend Income and Growth portfolio in December of 2011 and was sold in February of this year. We realized a gain of a whopping 274% over that time frame. Furthermore, we purchased semiconductor manufacturer Analog Devices, ticker symbol ADI, in February of 2015. We held our position for approximately 71 months before selling in January of 2021. During that period, we realized a gain of 169%. Another example is Chip Foundry Taiwan Semiconductor, ticker symbol TSM. We bought TSM in May 2020 and held it for only 8 months before selling it for a stellar 123% gain over that period. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUELINE. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. Now let's turn our attention and have a brief discussion about the current economic environment. The following content was prepared by Valueline senior economic staff. The U.S. inflation situation remains sticky. The war confirmed This was confirmed by the September readings on consumer and producer wholesale prices. Indeed, both the headline Consumer Price Index, CPI, and the Producer Price Index, PPI, figures were stronger than expected, reflecting in large part the increase in energy costs. The core CPI and PPI, which excludes the more volatile food and energy components, moderated a bit. That was an encouraging sign for Federal Reserve officials, but the pace of price increases is still running well above the central bank's target rate of 2%. Treasury market yields recently hit levels not seen in more than 15 years. This may ultimately do the work for the Fed in its attempt to slow demand and put downward pressure on prices. While interest rates are likely to stay high for a longer period, we think that this can occur without additional hikes from the Federal Reserve before the end of this year. Investors should note that a mid-October Treasury market auction was very disappointing to the government, and yields moved higher on the weaker demand for fixed income securities. Meanwhile, third quarter earnings got off to a good start. In particular, a number of the big money center banks, including JP Chase and Bank of America, surpassed revenue and earnings per share forecasts. An overall solid performance from the S&P 500 companies will likely be needed to justify their current valuations in a rising interest rate environment. Of note, a better than expected reading on September retail sales was an encouraging sign for leading retailers ahead of their latest quarterly results. Escalating geopolitical unrest is a concern for Wall Street. This includes the ongoing wars in the Middle East and Ukraine, as well as the mounting tension between China and Taiwan. JP Chase head Jamie Dimon recently opined that the geopolitical turmoil and rising interest rate environment will have a far-ranging impact on energy and food markets, global trade, and geopolitical relationships. In conclusion, a potentially solid third quarter earnings season may provide near-term support for equities. However, we still recommend some caution given the specter of even higher interest rates going forward and the aforementioned troubling events overseas. Now I'll walk you through the selection process for the latest stock to join the Valueline Dividend and Income Growth portfolio, Merck, ticker symbol MRK. So now I'll show you how to access it. Once signed in, head to the dashboard where I'm already located. This is the main landing page for subscribers where you will find economic commentary, supplementary reports, and up-to-date content. You can see all that in that area over to the right. From there, we want to choose Browse Research and navigate to the screener. One thing I want to touch on is that the screener is just one element of our selection process and helps us sift through the thousands of equities in our database using targeted, relevant criteria. Anyone can randomly select different screening criteria and come up with a list of stocks. But what separates Valueline's Dividend Income and Growth is that this is a curated process, starting with specific complementary criteria to meet our requirements. So step one is a safety rank of 1. We want to focus on companies that are significantly safer than the average equity under our review. Hence, we will focus on companies that are ranked 1 for safety. Keep in mind that our safety system ranks stocks from 1 to 5 based on their relative risk profile. After screening for this, we have whittled our list down to 110 stocks. Step 2, financial strength rating of A++ or better. This is a metric that measures how financially sound a company is. When taken together with an above-average safety score, we are focusing on companies that are financially healthy, with stocks that tend to be less volatile than the broader market averages. After screening for this variable, we have narrowed our list down to 47 stocks. Again, you can see that right up on the right portion of the screen. Step 3, timeliness rank of 3 or better. We want to focus on stocks that are ranked to at least match the performance of the broader market averages in the year ahead. After screening for this factor, we come down to 43 stocks. Step 4, dividend yield of at least 2.5%. We want to also take a look at the dividend yield. While we are looking for stocks that have solid dividend growth potential, we also want to focus on equities that have a yield that is at least on par with the Valueline median. After conducting this screen, we are down to 17 companies. Step 5, projected 5-year earnings growth of at least 8%. It's also a good idea to focus on companies that are able to grow earnings at a healthy clip over the long term. Companies that can generate solid growth and net income are able to increase dividends as they would be well covered by profits. After running this screen, we have trimmed the list down to 9 names. Step 6, dividend growth of at least 7% over the next 5 years. As the name implies, this product is about dividend growth. Hence, the final screen will focus on dividend growth of at least 7% over the next 5 years. Now, after this screen, we have dwindled our list down to six results. And then, after this point, after a spirited discussion amongst our senior analysts and our economists, we decided that Merck would be the newest featured selection for the Valueline Dividend Income and Growth portfolio. And there you can see it listed within that group of 6 results. Now, a little bit about the screener. Valueline subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUELINE. Please note that the screens can be saved and revisited by utilizing the Create Saved Screen button at the top of the page. Now let's click on Merck, where we find the landing page for the stock and Valueline's digital report. Okay, so you just click on the name within that list. And we can click on the PDF reports here at the top of the page to find the most recent full-page report on Merck. Now, we can go back to the Dividend Income and Growth report and take a look at that one as well. This is the Valueline Dividend Income and Growth report that was published very recently. So you click on the Dividend Income and Growth section, and then at the top of the list there, the most recent report is Merck. And as you can see, if we scroll down to page 8, we can look for some of the reports, the reported numbers, and you can see that Merck had posted solid top and bottom line gains next year on the heels of a likely sharp earnings decrease this year. So it just gives you a synopsis of the results. And it should be noted that the reduction in profits this year is largely due to a significant decline in sales related to the treatment of COVID-19. Hence, we believe the comparisons will be easier next year, while a strong product pipeline augurs well for a healthy profit increase. Subscribers should note that our Dividend Income and Growth product offers a featured selection, which is Merck this month, while also having an alternative selection. The alternative selection for this month is Federated Hermes. Other noteworthy sections in our dividend income and growth product include a dividend section on Valueline economics, which reviews the most recent view of the economy and stock market. Also, we have a section that updates the relative performance of both the alternative and featured portfolios relative to the benchmark S&P 500 index. It should be noted that the stocks we select for the dividend income and growth product tend to be more conservative in nature and thus in general tend to perform better than the broader indexes in turbulent times, but may not perform quite as well during the very strong bull markets. Of course, the dividend yield and the potential for strong, solid dividend growth provides a degree of stability for investors. We typically try to hold positions in the dividend income and growth portfolio for at least 6 months before considering a sale. Of course, though, this depends on the broader economic conditions and the health of the overall stock market. Generally, we try to diversify the dividend and income growth portfolio across a variety of sectors in order to help boost the overall return. While it may be tempting to focus on stocks in high growth segment, for example, as the old adage goes, it's not a good idea to keep all of your eggs in one basket. It should also be noted that while we screen for dividend income and growth selections, we also discuss qualitative factors that may add value to parameters that we screen for. The screens are good for quantifying metrics, though sometimes there are qualitative or intangible variables that are difficult to incorporate into the screen. Product brand awareness, management, and susceptibility to sharp economic downturns are just a few of the examples of factors that may be difficult to screen for. We hope this gives you a good overview as to how we screen for dividend, income, and growth stocks and what is included in our monthly report. We'll now tackle a few questions. Please note that we typically can't answer complex questions without specific stocks on the spot. The first few questions were submitted prior to this presentation. I'll now hand it off to Alan.
Thank you, Kathleen, and thank you all for attending our presentation. We had a few good questions submitted prior to the presentation as well as numerous during the presentation. The first one that caught my eye was, when is the right time to sell a dividend-paying stock? And as Kathleen alluded to, we buy a stock for the portfolio or hold a stock in the portfolio with the intention of holding it for at least 6 months. Of course, things happen. We're in a very tumultuous market right now. And, sometimes stocks go up or down by more than we anticipate. But we do have a stop loss trigger when a stock declines in a 25 to 30% range. So we have an automatic sell when it hits that threshold. Also, when a stock increases by a certain percentage, that's a little more subjective. We'll consider selling it. Our philosophy is we want to make the best use of the funds within the portfolio. So if a stock has gained a lot of ground and reached our price target, we'll likely sell it. Or if it's lost a significant amount of ground and hit our stop loss target, then we will sell that as well. So it varies. Ideally, if you're a conservative long-term investor, you want to invest in dividend-paying stock they can hold for the long term. And, I think our portfolio, for the most part, has a lot of those stocks, some of the household names. There's also another question regarding someone that says they only buy companies that pay dividends 4 times per year, and it says, do you agree? And my answer to that is yes, I do agree. I think it is important for a company to pay a quarterly dividend. For one, they can adjust and increase as needed. Generally, quarterly paying companies increase once a year, but it's good to have that latitude in case conditions change, for the better, for the worse. But it's also good if you're a dividend-seeking investor. It's good to have that quarterly distribution. So I think if you're in the market for dividend-paying stocks, I think, for me personally, I think the quarterly payout is the way to go. Of course, everyone has their own objectives, et cetera. But I think for the majority of dividend-seeking investors, the quarterly paying stocks are the way to go. Kathy?
Yeah, I see a question that was submitted referring to screening within a particular sector. Someone asked, how do I use Valueline to pick a dividend stock in the technology sector? So just as we went over the 6 different steps that we use for screening, there's also an area on the stock screener main page that has an industry selection. So you can just click on that industry and there's a drop down. And if you're interested in technology like this particular person, you can check off technology or any of those subsectors within technology that interest you and then carry on the screen from there. So it's pretty straightforward if you're interested in one particular industry.
Okay, thank you, Kathleen.
Sure.
I'm sorry, go ahead, Kathleen.
Yeah, there was another question that I thought I'd just tackle regarding ex-dividend dates. Someone asked, I hear the term ex-dividend date used with regard to dividend stocks. What does the term mean? Well, the dividend date is important because you need to own the stock before its ex-dividend date in order to be eligible to receive the next dividend. And in fact, in our monthly report, we have a table that lists the stocks in our portfolios, the featured portfolio and the alternative, and then also the corresponding ex-dividend date for those stocks. So looking at that date when you need to own the stock in order to receive the next dividend payment. So it sounds a little tricky, just ex-dividend date versus other dates, but it's pretty straightforward. And Alan, did you want any other questions?
Thank you, Kathleen. I saw another one that came up. Someone asked, how do you judge debt load on a dividend-paying stock in general? What do you see as red flag that would cause you not to take a dividend-paying stock? And that's definitely one of the things we screen for directly. I mean, we look at the safety rank of a stock, which we noted earlier is between 1 and 5, with 1 being the safest, 5 being the least safest, and also the financial strength of a company. So those 2 metrics together usually tell a lot. Not usually, they tell a lot about the debt level of the company and its ability to meet its debt obligations. Of course, even taking those factors into consideration, we still look at the individual debt load of a company. So, of course, if a company has a lot of debt, it could be concerning, but we just want to make sure that it has the cash flow to service those debt obligations. So that's definitely one of the things we look at. But again, our safety rank and our financial strength metrics, they take into account that as well. Kathleen, do you see any other questions?
Just a couple questions with regard to the number of stocks in the portfolios. So, it depends if we're in the midst of selling a particular stock, but on average, there tends to be 10 stocks in each portfolio, 10 in the featured, 10 in the alternative. That was seemed to be a repeated question that I saw.
Okay, thank you, Kathleen. Also, I want to note that on our featured selections, we do supplementary reports as the companies report earnings. Like, for instance, today Merck reported earnings, so we did a supplementary report on that company for our Dividend Growth subscribers. So that's a feature that we have as well. That's good to keep up to date on the earnings results and any pertinent news regarding those companies. I also see a question. Someone asked about the difference. We noted the timeliness ranks in our screener, and someone asked the difference between the timeliness ranks, the 18-month and the 3 to 5 year, and that's all interesting. We focus on companies that have a timeliness rank of at least 3, which means they're likely to match the market averages in the year ahead. though it's not included in this particular screen, we do look at the 18-month and 3 to 5 year potential as well for a lot of our selections. The 18-month variable is for like the intermediate term horizon that we instituted that probably 6 or 7 years ago. And the timeliness is 6 to 12 months. We also look at the 3 to 5 year price targets, but the 18-month is kind of that intermediary, and a lot of our subscribers and a lot of investors are interested in that as well. So just because we only screen, we screen for these variables, there are a lot of other things we look at as far as that. And once we get to our final list, like in this case with 6 stocks, we do, our senior analysts, our economists, we do look at that and then discuss to find the stock which we think is going to be the featured selection for that month. Kathleen, do you see anything else?
No, I think that's all the questions we have. Unless you want to, if there's anything else that you see, maybe you should just hand it back over to our host.
Yeah, let's turn it back over to Riley. We thank you all for joining us. Riley?
Thank you so much. And to everyone who took the time to join us today, we thank you for taking the time and doing so. Have a wonderful rest of your day. We'll see you next time. Thanks again.